Today, the growth doom loop that no one wants to talk about. Hi again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and property news. Today, we got the last piece of the national accounts data from the ABS for the second quarter of 2025. The GDP result was much better than many had expected because, although analysts had tipped a 0.4% rise in headline GDP and the RBA had forecast a 0.5% growth rate, the final number came in at 0.6%. And the headline GDP grew by 1.8% over the 2024-25 financial year. Arguably, this reinforces the case for the Reserve Bank to keep interest rates unchanged later in the month, unless unemployment turns shockingly sour when next reported, warts and all. Money markets, by the way, still think the bank will stay on hold in September, but will cut in November. But then they've reduced their easing bets for the first half of 2026. The ABS said that economic growth rebounded in the June quarter, following subdued growth in the March quarter, which was heavily impacted by weather events. Domestic final demand was the main driver of growth, led by household and government spending. Public investment was the largest detractor from growth. Net trade also contributed to GDP growth, led by exports of mining commodities. Now, just bear in mind that the broader economy is underperforming compared to its 20-year pre-pandemic average of around 3% per annum. Looking at the data, we can see that the upside actually came on the back of stronger than expected consumer spending, which was up 0.9% across the quarter. While some of this appears to be due to one-off items relating to holiday timing and sales discounts, underlying momentum looks a little firmer, with rising growth in households' disposable incomes and improving consumer sentiment, at least to some extent. Outside of the consumer, new business investment declined, and while we've passed the peak in terms of public demand contribution to growth as well, this is significant. Today's data show that public investment was the primary drag, actually, as the pipeline of public investment projects turned lower. That's feeding into weaker activity. This quarter, new public investments declined 3.4% over the quarter, to be 2.9% over the year lower in annual terms. The decline was shared across all levels of government, both defence and non-defence at the federal level. Public corporations did provide a bit of an offset, with investments up 2.6% over the quarter. Public consumption did rebound after last quarter's sluggish outcome. There were gains across defence and non-defence. Federal spending, as government programmes such as the NDIS continue to expand, and the final rounds of cost of living support flowed out of the door. At the state and local level, consumption slipped down 0.3% over the quarter. Meanwhile, public consumption grew 1% over the quarter, mainly due to notably higher national government spending, which was up 2.4% over the quarter, relating to social benefit programs, healthcare, and other things, amid, of course, rising bulk billing expenditure and worse than usual flu seasons as well. But there has also been a pullback in state and local government consumption as temporary costs of living support have been wound back. So, in other words, day-to-day spending by governments is still running very hot, but investment spending, which can lead to future growth, not so much. Turning to households, the long grinding per capita recession did end with a 0.2% rise in GDP per capita in the second quarter and a 0.2% increase year on year. That was the first time since the March quarter of 2023 that GDP per capita increased in annual terms. But despite the rebound, Australia's per capita GDP remains 1.3% below where it was when the Albanese government came to office. After experiencing the largest fall on record coming out of COVID, household incomes did stabilise in 2023 and have been steadily recovering since then. It seems that the triple headwinds of bracket creep, surging prices, and high interest rates have subsided a little, with tax and interest rate cuts now supporting disposable income growth. Indeed, the annual household disposable income growth hit 4.1% over the year this quarter, which is the highest pace since 2011 outside of the COVID period. But note that real inflation-adjusted disposable income basically held flat. And of course, costs have continued to rise. So there is really no surprise to see a lift in spending as inflation still dilutes spending power and the consumer has been relatively cautious, though it's worth saying that they've looked to save and to rebuild buffers rather than to spend, at least some, with money to spare. In terms of the spending detail, retail components posted a 0.4% gain, while vehicle purchases rose 2.4% over the quarter despite sales figures that look to have been about flat. So perhaps the difference is relating to insurance-funded replacement purchases. Fuel spend was up 0.7% over the quarter, but services spend excluding utilities recorded a much stronger than expected 1.4% quarter rise. The detail here shows a particularly strong rise for recreation and culture, up 2% over the quarter, the biggest gain in 3 years. And together, recreation, vehicles, hotels, cafes and restaurants, and transport services accounted for 0.4 percentage points of the 0.9% quarter rise in total spending. Now, the ABS did highlight that the end of financial year sales and new product releases drove discretionary spending, as well as the close proximity of the Easter and Anzac Day public holidays, which did help to boost outlays on hospitality and recreation services. So this quarter, consumers are spending more, but are also pulling on savings. So the savings ratio fell from 5.2% in the March quarter to 4.2% in the June quarter, bringing it back in line with the 4% rate over the second half of 2024. Some of the consumer strength is likely to be due to the one-off activities in terms of holiday timing and attractive sales discounts, and this aspect will unwind in the September quarter, of course. Some analysts suggest that consumers are feeling more confident now, and some clearly are. But for those in the strangling rental sector and those with large mortgages, spending remains focused on non-discretionary items rather than spending from choice. Our latest results to the end of August in our household surveys show that many households remain in a state of financial pressure, and even the expected rate cuts ahead will only have a marginal positive impact. Now, we should note that the Commonwealth owes $961 billion and will cross the $1 trillion mark in the first half of next year, because while the Australian Office of Financial Management is adding about $10 billion in borrowings every month, about $45 billion in bonds mature just before Christmas. The Australian government's gross debt has jumped from 5% of GDP to 37% in the past 15 years. However, it remains well under Japan's 216% and the United States' 124%. According to Treasury estimates, the government currently pays around $2 billion in monthly interest costs, with the bill expected to rise to $3 billion by the end of the decade. Now, Alex Joyner, chief economist at IFM Investors, said that while public debt has yet to reach crisis levels, the government needs to get its fiscal position in order. And he says that there was no correct level for a country's debt to GDP ratio. The threshold is reached when the market decides it's just too much. When the bond vigilantes start rubbing their hands together, then you know that's the level that you start to worry, he said, pointing to the US or France as the example where high public debt has become a concern. And of course, in the UK, public debt over 30 years is now touching very significant highs. While Australia could likely handle more debt, increasing interest payments will detract from spending on other important areas. We'd rather have a more balanced budget so we don't see our interest payments exceed our defence spending, for example, which is the case in the US, he said. So while the government is focusing on driving economic growth, this was being supported by more public spending rather than meaningful reform. Public demand, as a proportion of GDP, is much higher in Australia at 28% compared to 17% in the US. So we need to reinvigorate the private sector. And everybody will be on board with that, I think, particularly the Reserve Bank of Australia, who is looking for this rotation back from public to private. Now, sure, the higher yields paid in Australia will attract foreign investors, with 10-year yields paying around 4.3% compared to 3.4% in Canada and 1.6% in Japan. But of course, we are seeing longer term bonds being priced higher, and this will put greater pressure on the government as the debt servicing costs rise. So the upward pressure on deficits and interest payments will simply get worse. What is missing in all of this is a real growth strategy. But we do seem to be in the same doom loop as many other Western countries, because higher deficits mean higher yields on bonds, which puts more pressure on the government to service them, which means that we need higher taxes, which reduces growth, which increases the deficit. Rinse and repeat ad infinitum. So despite the recent productivity roundtable, nothing so far has changed to break out of the low growth path. So as a result, ordinary Australians will end up paying the price. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.